Hey everyone, and welcome back to my channel where we talk about everything investing and focus primarily on dividend stocks. In today's video, we are going to go through my entire dividend portfolio and give you a February update on what changes I've made over the past month. I will take you through my dividend portfolio tracker. We will detail out any additions I've made, subtractions to the portfolio, take a look at our projected dividend income for the year, and all that great stuff. So make sure you stay tuned throughout the entire video. With that being said, I put out all of this content for free, so if you could do me a huge favor and click that like button down below, that'll be instrumental for the growth of this channel moving forward, and consider subscribing so you are notified anytime we drop a new video. With that being said, let's get started. As always, everything discussed in this video is for educational and informational purposes only, as I am not a financial advisor, so please perform your due diligence before investing in any stock or ETF mentioned in today's video. And also check out my link down below for M1 Finance, as they are giving away $50 free for anyone that signs up a new account. And for those that are looking to get involved with cryptocurrency, check out my link down below for BlockFi, where you will get free Bitcoin for every new account. All right, with that being said, let's get started with our February dividend portfolio income. And let's begin by taking a look at where we were in January. We had a portfolio cost basis of $168,217. A market value of the entire portfolio of $196,439. We were sitting on unrealized gains of $28,311 with an unrealized percentage gain of nearly 17%. Year to date, the portfolio was down $3,400, and we had projected annual dividend income of $4,781. Now remember, when looking at this, let me bring up the portfolio for February. When looking at the top up here, what I like to call kind of the dashboard, the cost basis is the amount that I have invested in the market right now. The market value is the value of what those dollars are worth today based on the appreciation of the stocks. So right now I'm sitting on unrealized gains of $28,886. which equates to an unrealized gain percentage of roughly 17%. So if I sold everything right now, I would have a 17% gain. In terms of year-to-date performance, the portfolio has been performing quite well, considering we have had a very volatile start to the year for these first 2 months. And right now the portfolio is down $3,700, roughly 1.8%. But right now, as you will see, we have upticked our projected annual dividend income roughly $100, and now we are projected to receive $48.70 over the next 12 months, which equates to a dividend yield of 2.48%. Now I know some of you from the last video had some questions on the headers, so let me go through these again. Obviously, the first one is just going to be numbering out the number of positions I have. Then we have company name, the ticker symbol for that stock or ETF. Shares is the number of shares that I own. Current price, which is going to update on a timely basis, is the current price of that ETF, index fund, or individual stock. The market value is simply taking the current price times the number of shares I have. So right now, the Vanguard S&P 500 index fund, I own 52.84 shares, which they trade at $413 and change, which means I have a market value of nearly $22,000. The weight percentage column is going to tell me how much, or tell you how much this position is of the overall portfolio. So this Vanguard S&P 500 index fund equates to 11% of the entire portfolio. Cost basis is what I've bought into on an average basis, and the cost basis dollar amount is how much I have invested in that particular position. Next, we'll go more to dividend stats. So you'll get the annual dividend per share. So this Vanguard index fund pays roughly $5.44 per share on an annual basis. Now I own 52.84 shares, so that means my annual dividend income is roughly $287 for this particular position, which equates to a dividend yield of 1.3%. And if we go all the way to the right, we'll see the yield on cost, which just takes the amount, my cost basis, compared to what I am receiving in dividends right now. So now let's just quickly go through all of the positions and see some of the changes and where we're at. So no real changes at the top here for the first three positions, the Vanguard, S&P 500. Many of you know that I love dividend growth stocks, so you're going to see that Vanguard Dividend Appreciation Index Fund, and then AbbVie, my largest individual stock ownership. And they have just been on a tear lately. It pays a great dividend. We're getting some strong growth potential and strong dividend growth. You know, that's why I refer to it as the investor's trifecta. The fourth largest position in the portfolio is Bristol Myers Squibb, which they actually jumped Johnson & Johnson this past 30 days or this past month, as they were in the fifth position. So now those two kind of flip-flop spots, and Bristol Myers has been, performing quite well. It accounts for 4.86% of the portfolio. We're getting a 3.2% dividend yield. So all great things from BMY there. The fifth position, as I just mentioned, is Johnson & Johnson. And then followed by that is cash. So over the past 30 days or so since I last updated you, I did make some sales, and we're going to go through all of the transactions that I've made over the past 30 days or since that last portfolio update that I gave. So cash is still a reasonable position in my portfolio. I'm just looking for some good opportunities, and with this volatility, I think we will definitely get those. The next largest position in the portfolio is Apple. This is a staple of many portfolios out there, so not much more to say on that one. Here's another S&P 500 index fund, and some of you in the messages of the last portfolio update had asked, hey Mark, why do you have so many S&P 500? Now this dividend portfolio tracker that I put together is a mix from all different accounts, and I'm trying to put everything into one account because I have a portfolio or a account on M1 Finance, and I have different accounts on Vanguard as well as Fidelity, different retirement accounts from old workplaces and stuff like that as well. So the next position I have is the Schwab Dividend ETF, SCHD, one of my favorite ETFs by far, something I look to add to on opportunities, and one that you will see here that I added a little bit to recently. It's just a broad-based, great, solid ETF to invest in for dividend investors. Next is Lockheed Martin, and this is a defensive contractor, the largest there is. And they've been winning contracts left and right, and with the tensions we're seeing with Russia and Ukraine, with the threats of war, you're going to get seeing defensive stocks creep up a little bit. So we'll see if we actually get that. The next property or the next position we're going to talk about is Vici Properties. This is the first REIT we've mentioned. They are a triple net lease REIT. They are in more of the gaming industry. Next is the Vanguard High Yield ETF, stock ticker VYM. So where SCHD is more broad-based, VYM focuses more on high yield. We saw with the second largest position I have, which is the Vanguard Dividend Appreciation. They're looking for dividend growth, but Vanguard High Yield is first and foremost focused on higher yield, as you can imagine in the name. Next is Visa, as we've talked about before. There's so much pent-up demand, especially here in the US, but just all around the world for folks that are looking to get out and travel, and Visa will definitely benefit once that happens. Next is Deere Company, which I refer to as the Tesla of the agriculture industry. Yes, Tesla of the agriculture industry. They are putting in full self-driving technology into tractors, which will transform the agriculture industry. So although you get a low yield, they're growing their dividend at a decent clip, plus you're getting strong growth potential with Deere. The next name on the list is Altria Group, which you're going to get a 7% dividend, and they are a dividend king, meaning they have paid not only a dividend, but an increasing dividend for over 50 consecutive years. They are followed by the Consumer Discretionary ETF, the iShares Dividend Growth ETF, which is again another ETF that's focused on dividend growth stocks. And you guys know me, I love dividend growth. We have that long roadway, long trajectory. I want to take advantage of the power of compounding dividends. We've heard it before that compounding interest or compounding dividends can be considered the eighth wonder of the world. Next, we have the Vanguard Tech ETF. So a lot of big tech names there. You're going to have more Apple and Microsoft, Amazon exposure there. Now we're going to go on a little bit of a REIT run. So we have WP Carry, which is a newer position in the past couple months for me, followed by National Retail Properties, and then Realty Income. So, both of those are very strong triple net lease REITs. Next, we have Starbucks, which is, a company that has gotten off to a very rough start here in the year 2022. So just looking to take advantage of the drawback there, which, some investors are worried about the talk of unions coming on and affecting labor costs, how inflation and supply chain costs are coming. All of these I believe to be temporary. Next, we have Verizon Wireless, which again is a high yield stock, followed by Iron Mountain, Simon Property Group, which is another REIT, the largest mall owner in the US, another S&P 500 ETF, followed by Public Storage, which is a self-storage REIT, one of the largest, another defense contractor with Raytheon, followed by Microsoft, Store Capital, which is similar to Realty Income, focuses more on the middle market, where Realty Income has more of that investment grade tenant base. Store Capital, it's a position I have liked for many years. I have interviewed the CEO, Chris Volk, or the former CEO and chairman, who has recently left the company, which has gotten me, less excited about this REIT. So it's kind of the wait and see approach with me right now with Store Capital. Next, we'll see Broadcom, which is a very strong, one of the strongest dividend growth stocks there is over the past 5 years. You get a solid yield. The company's been performing quite well, and that's shown in the share price appreciation. And then we have 3M followed by Bank of America, which, as you'll see here in a second, is a new position for this portfolio. We're in an environment where we're going to see rising interest rates, and a company like Bank of America is primed to take advantage of those rising rates. So that's the dividend portfolio for February. And as we saw at the top here, our projected annual income is $4,870, which is roughly $100 more than where we were in the previous update, which was roughly 30 days ago. So let's take a look at some of the transactions that I made since the last update to improve our dividend income. In terms of new positions, we added Broadcom, or stock ticker AVGO. We added 3 shares for about $17.70 invested, which added nearly $50 of annual dividend income moving forward. Another brand new position to the portfolio is Bank of America, and as I just mentioned, they are primed to benefit from this rising rate. And what you want to look for with banks is net interest margin, which is the difference between what they can borrow money from you. They're paying you for your checking account interest or that low savings account interest, and they're going to loan that out. The difference is the net interest margin. Look for that to grow as the interest rates increase and they're able to increase their leverage for what they loan money out to. So we added 23 shares, which was roughly $1,000, and that added roughly $20 in annual dividend income for the next 12 months. So those were the 2 brand new positions. In terms of positions that I increased to old positions, was Realty Income. I've had Realty Income now for a while. I added another $1,000 to it. It creeped down a little over 5% of late, so just wanted to add more to this monthly dividend paying company. I also added $500 to the Schwab US Dividend ETF that I mentioned. When I see opportunities in SCHD, even if it's just a little bit I'm adding, I look to take advantage of that. So those are all of the additions for the past 30 days or since the last update. In terms of positions I exited, I completely exited out of the ETF QQQJ, which is the next gen Invesco ETF. All right, now that we've taken a look at the positions in the dashboard up there, let's take a look at the Dividend Income Tracker tab. So that's just the next tab here, and this is going to show us on the top here our dividend calendar. It's going to break down the dividends I'm actually receiving month over month. So as you can see, in January, we received roughly $200. February, once that's over, we're expected to receive close to $335. And then March, we will receive over $556, which will be our largest dividend month to date. And for the year, we are projected to take in $47.45. And I know some of you are asking, Mark, why was there a disconnect between the projected annual dividend income and the annual total income on the second tab? So the second tab is tracking actual. So if I make investments in throughout the year, so as you could see here, realty income, the first 2 months we received $8.61. This is a monthly dividend paying stock, but I recently added to the position. So you can see that it's going to creep up to $12. What we're showing you on the projected annual dividend income is from this point forward, the next 12 months, $48.70 is what we're expecting. Whereas the second tab is going to show us what we're expecting for this year in particular. So some of us, as there's changes coming in and out, we may receive stocks. If I sell out of a position, I'm going to keep that dividend income on here. So that's the slight difference you'll see there. But one of the exciting things, if you look over here, is we are expected to grow our dividend income by 56% this year. That is incredible. I do not expect 56% each and every year, but that is some incredible growth as we have been pouring money into the market over the past 12 months and investing in these dividend growth stocks. If you look a little bit further down, you're going to see a chart that's going to break down our monthly dividend income. The blue charts and tables are going to be 2022, and then the red sections are 2021. So you can see that broken out by month, how we compare year over year. So the last tab we'll take a look at here is the portfolio performance tab. And this is just going to show our ending balance. This is going to incorporate all of the positions that I'm selling out of. So, where you don't see it in the portfolio anymore, if I sold out of QQQJ, everything's going to be incorporated here based on the ending portfolio balance. And then this is just going to roll forward to the next month. And then if I add money, it will be added here in the contribution section. So you can kind of see we started with 193 in January, but I added 6,000 because I funded my Roth IRA. So our starting balance was 199 and we ended at 195. So you can see the last month we lost about $3,900. So as this fills out month by month, our graph over here will change, and just showing how the portfolio as a whole in terms of the balance hopefully continues to climb higher. So overall, that is the portfolio update for February. We sold out of QQQJ. We added some high quality, high growth, dividend growth stocks such as Bank of America, which is a very strong dividend growth stock itself, and Broadcom, a very, very strong dividend growth stock here in the month of February. We added to some positions we already had, such as Realty Income, which is a monthly dividend paying company. And we also added to our SCHD position. So, another one that I wanted to briefly mention is, keeping on the radar, and I think I added it right before we did our monthly dividend or the reveal of the portfolio, is Starbucks. Anytime Starbucks gets under 100, it hasn't been under 100 for, quite in some time now, this is a stock that is high on my watch list right now. As I mentioned, they're going through these temporary headwinds, but the company, as China reopens and they're adding more locations here in the US, the company is performing quite well. Some other names that outside, I don't just invest in dividend stocks. Dividend stocks makes up the majority of my portfolio, but I also have a bucket of growth stocks where I'm invested in the likes of Google's and Amazon's. But one I have added to recently and I'm very high on still is the Walt Disney Company, stock ticker DIS. They are crushing it with Disney Plus and their latest release of Encanto. I know my kids love it, and it has gotten rave reviews. The parks are starting to come back, and they performed quite strongly in the latest earnings release, and I expect that to even grow more now that their mask mandates are lessening even more in the coming days. There is no more mask required for vaccinated individuals visiting Disney World or Disneyland here in California. So those are, Starbucks being a dividend stock, Disney being a non-dividend stock, but a prior dividend paying company. And hopefully we will get that dividend reinstated one day once they're done pouring money into the Disney Plus expansion, which I am completely fine with as a shareholder right now. So that's the update for February. Let me know also of some of the common holdings we have down in the comments section down below. I would love to see those and hear about them as well. Well, I hope you guys enjoyed the video, and if you haven't done so yet, check out some of my latest videos where I discuss 3 high-yield dividend stocks as well as top 5 REITs to invest in right now. I hope you enjoyed the video, and we will see you next time. Take care.